In this video, I will backtest the covered call method in a bull market in the year 2017. And the rules of this trade is it's an always-on trade style. I'll use SPY as the underlying. I will own 100 shares of SPY. I will include a commission of $1 per options contract and 0 per share of stock or ETF. I will allocate enough positions to use all the available margin when applicable. I'll run the test through, in this particular case, the bull market of 2017, which started from January 1st or 3rd until December 31st of 2017. I will sell the 40 delta calls that expire in approximately 30 days. And I'll wait for the call to expire before selling another call or reestablishing a new position. And we'll take a look at the results after this backtest has been completed. Okay, so this is the covered calls backtest. Let me go back and start with 2017, January 2nd. That wasn't a trading day. January 3rd. Oh, and by the way, before I get started here, if you're interested in the backtest software that I'm using called OptionNet Explorer, I put a link below about my experience with OptionNet Explorer and also a link for a 10% discount if you want to purchase this software. Let's go about 30 days. There's 29 and 31. I'll take the 31. These are the calls. So first thing we're going to do is buy these 100 shares. So I'm going to commit this trade. Just call it trade 1. Now we own the shares. We use about $11,278 in margin, or cash $22,557. Now we're going to go ahead and sell which covered call. Sell a covered call. Well, which one are we going to sell? Well, I'm going to go with one that's probably closest to about 40 delta. Okay, so I'm going to sell one because it's 1 for every 100 shares. Let's commit that. Now we're going to go 30 days in advance. This expires on February 1st. So let's go to February 1st. And here's how we end up. So the question is, at the end of this day, do we get called away? Yes, see how it's over $227? So what we need to do is sell these shares, let this expire. Won't do anything to that, but we're going to sell these shares here for $227 even. Okay, we'll let that expire. So at the end of the day, so we'll go to the next day. And we'll start over since we got called out of our position. This one's about 29 days. Let's buy our 100 shares. About 40 delta, 30 days out. Sell that call. Okay, so we have until March 3rd. Let's go there. All right, so we definitely got called out. Got called out of our shares at a price of $229. That's 100. $229. And we're going to start over. go 30 days. Right here, we need to buy some more shares. We'll go long. Paying 237. And we want to go about 40 delta. Looks like there's not a lot of strikes available, so we'll go here. We'll go over here. It's 39, so -1. We'll pick up some premium, $1.50. And we'll go, and this expires on April 7th. Let's see what happened. We are still going to own the shares because we paid $237, so we didn't get called away with $239. We didn't get called away. Okay, so this is going to expire, and then we'll go to the next day, and we'll sell another call. Okay, we'll just buy this back for nothing. We should keep our shares there for the next day. Now we'll go 30 days out. Right here, not a lot of strikes available. Probably go here. 40 delta. Here's 39. -1. Collect $2. Okay, let's go to May 12th. And 238.96, 238. So we did get called away. We're going to buy this back for 0. And then we're going to trade our shares out at 230 at 238. Okay. Now we're going to start over. We got 2 to choose from here. We'll go with the one that has more time. Let's see. We need to buy 100 shares. You can see we're using around $12,000 to do all this. What does this trade? 4, I think. Okay. And we want to go about 40 delta. Gotta go between 44 and 30. So I'll pick the one that's closer. -1. Get about $2 for that. This expires on June 14th. So 240, and we're at 244. So we got called away. So we're going to buy this back for nothing. You don't get to keep all that. And we'll buy this back at 240. I should say, we'll sell it at 240. That's what we got called out at. I should say, when I said we didn't have to keep all that, I should have meant we don't have to pay all that. Okay, so now let's start over. 30 days. We're going to buy 100 shares. That's 100. And we're going to sell at the 40 delta approximately. Ooh, we got the 45 now, so we're going to take the higher one. -1. Okay, let's go ahead and execute this first trade. 5. And then we'll execute this. And then we'll go to July 14th. See what happens. We have the 245 call, and it looks like we just barely made it to where we were able to keep our shares. So we'll buy this back for nothing, for 0, because we let it expire. And we still have our shares, and we'll go out another 30 days. 28 days looks better. We got the 40 here, 40 delta, -1. Commit that. Pick up another $1.38 in premium. Then we'll go to August 11th. Oops, August 11th. And we're at 246, 243. Okay, so again, we get to keep our shares. And we'll buy this back at 0. And we still own those shares. We'll go 30 days out. And we'll go approximately 40 delta. We'll sell, pick up some premium. Get $2.23. And this expires on September 8th, so we'll go to September 8th. And we're at the 246, and this goes to 246.67. So we're going to have to get rid of these shares. We're also going to keep the premium here for this, so we're going to take this out at 0. And what was that? Strike, it was 246. So we're going to sell these at 246. Okay. Now we need to start over. So we got called away. We used the 28 days. We will buy 100 shares. Oh, now that's over $12,000 in margin. Okay. Let's commit this. Get trade 6, I think. And we want to go for the 40 delta. Here's 38. -1. Let's commit that trade. Get $1.15 this time around. We're going to go to October 6th. $2.48, $2.54. So we got called away. Let's go ahead and buy this back for nothing. We don't get to keep all that, or we don't have to pay all that. $2.48. So we sold $2.48. Let's start over. I'm going to buy 100 shares. I think this is a trade 7. Should be trade 10. I don't know. It's trade 7. We're going to go to 40 delta. 45 minus 1. We'll sell that. Pick up some premium. $1.63. We're going to go to November 3rd and see what happens. So we have the 255 strike, and it's at 257, so we got called away. So we're going to go ahead and buy this back, or I'm sorry, sell this at 255. And then we're going to buy this back for 0. Get to keep all that premium. Okay, we're going to start over. We'll go with the higher one. And we're going to have to buy 100 shares. Trade 8, I believe. And we're going to go short right at the 40, or as close to the 40 as we can. And we'll pick up $1.69 in premium. This expires on December 6th. Let's see what happened. 259, 263. So we got called away again. This one was at 259. So we're going to sell our shares at 259. Okay. And we're going to buy this back for nothing. And we're going to start over. 100 shares. 9, let's call it. And let's go to 30 days. Out, go to 40. Delta, here's 43 minus 1. Let's see what this premium is. $1.71, we'll take that. And we're going to go to January 5th and we'll be done. So let's see, we'll be done with the bull market. So obviously we're going to buy this back. So 264, 272. So we had to sell this. We had to sell this at 264. Let's do that. 264. And we'll buy this back at nothing. I get to keep all of that premium. Okay, there you have it for the bull market test. Okay, now that we've completed the test, let's go ahead and run a report. Let's take a look at what the results of these tests were. You can see how many occurrences. Let's take a look at the Analyze tab. Nice straight equity curve. $3,062 is the profit. And we use approximately $12,000 in margin. Let's do some calculations. So 3062 divided by, we use about $12,000. 25.51% return using the covered call strategy in a bull market 2017. Okay, it looks a little different because I upgraded my software here, but what I need to do now is look at the buy and hold through 2017. So I'm going to go to settings. I'm going to create a new account for this. I want to start the exact same time. I want both of them to start on the same day and end on the same day, so I need to go back to the covered calls and go back to when this first was open. So this was first open on this day, so this is the same day I'm going to use, same time and day, when I'm going to open for the buy and hold strategy. So I need to go to that account on the same time and buy 100 shares of SPY. Commit that here. 17. Now, when am I going to close this? Well, let's go back to that. So back to the end of this. Could have been on the 4th or 5th. Let's see. So this is the end date. So this is when I want to close my position. Let's go back to that. And we'll close it here. Minus 100. Commit. And now we'll look at the report. Filter that out. And you can see our profit was $4,684. What was our margin? 11,278. Let's get our calculator here. So 4,684 divided by 11,278. That's a 41% return on margin. It looks like the buy and hold strategy would actually give you 41% return versus the covered call strategy in the bull market gave you about 25% return. Hey, don't forget to hit that like button on the way out. Thanks.